3-minute trader tip: trading virtuous and vicious cycles. When we trade, we get ourselves into a pattern, and that pattern is usually a pattern of development or a pattern of pain and lack of development. And this is often cyclical in that once you've got momentum in a positive way, that often continues, and once you've got momentum in a negative way, that also continues. And certainly what we want to do is mirror the first and break the second if it starts to kick in. So let's look at what we mean by virtuous and vicious cycles. A trading virtuous cycle is when we get positive trading events which increase our trading confidence, increase our trading compliance or discipline, because the relationship between confidence and compliance is absolute, and that has a positive impact on results. And this cycle continues and continues, and these lines get stronger and stronger as we develop as a trader. So that subsequent relationship between confidence and ongoing discipline, including the development or management of cognitive biases, is critical to this. Now, the strength or fragility of a trading virtuous cycle will be depending on what level of confidence you actually have, and that's based on the longevity of successful trading outcomes. If that starts to wane a little bit, then you may find that this confidence becomes more fragile. Secondly, of course, it's the ability not to succumb to bias, and we've done other videos on trading biases. And of course, the speed of recovery or resilience from a trader shock, because we know from time to time there's going to be something happens that just takes us aback. There is a more major loss than we expected, a major market event that takes us out of many trades at a time. We get a succession of losing trades, but it's our ability to be resilient. If we move to a trading vicious cycle, obviously this is the reverse. So we get a negative trading event creating decreased confidence, decreased belief in our system and the ability to follow it, and this obviously has a continued negative impact on results. So we've got a recency bias often happens, a worsening of a loss aversion, if we look at another cognitive bias. And what we need to do in this situation is have a circuit breaker. So certain tactics we can use is comparison of a pre and post event if we have a recency bias. If we're looking at our last 4 results and say, well, that means I'm a dreadful trader, when actually your previous 3 months have been good, then we can look to evidence to say that's okay. We obviously can start to dig deep into what is causing the pre-event circumstances. Is there anything that's happening at this stage here that says, well, that's ultimately a causation of that negative trading event, that repeated loss? And of course, what we can do is our ultimate sanction is to step back in terms of the level at which we're trading, restrict the number of instruments, and protect your capital during times of recovery. So consider where you are, virtuous or vicious cycle, and continue to do those things that are going to contribute to the former. And of course, let's look for a circuit breaker if you find yourself in the latter. Trade safe, and we'll see you again soon. Bye-bye for now.